we've been talking about as to how gold has seen a significant rebound since its August lows. So the obvious question is whether or not you should increase gold exposure in your portfolios or not. And as always, Dhirendra Kumar, CEO at Value Research India, joins in on the show to answer exactly that question for us. Dhirendra, hi, morning. Again, I know as a principle you're not quite fond of gold ETFs, but do you not think that at a time when the world is, in that risk-off mode, perhaps it's prudent to have at least 5 to 10% of allocation to gold as an asset?
No, gold principally, I'm not against gold ETF, but gold as an asset class. Because it is a store of value, nothing beyond that. It is not an investment. Investment is something which yields something for some underlying reason, and gold has none of those variables. It just sits in your locker, and if you have too much of it, you have to spend money to preserve it, ensure its safety, and it does not, any other asset, you have an earning stream from equity, you have a, interest coming from fixed income, you have rent coming from real estate. Gold doesn't produce anything. It entirely depends on fear. It entirely depends, great returns depend on, a very fearful outlook of future. That apart, it's a store of value. It has a very, it is a very old asset class. It has seen through generations. The modern financial system, so we have deep belief. Also the physicality of it, historically has lent some, credence to having gold in a certain form. So gold as an asset class in the modern financial system which exists today, I don't think one should look at it as an investment. And something happened, 10 years ago, when the fixed income market globally tanked, or the global financial crisis, that actually coincided with the financialization of gold. We saw the gold ETFs, we saw the gold derivatives, so that was the time when when gold really took off, and took off globally. We had a sudden surge of gold. The timing was perfect. The mechanism to actually own gold became simple. You can have it in a financial form, but gold as an asset class, and thereafter we have seen that thing as little bit of normalcy, and gold loses its charm as an investment. So I think it was a one-off situation.
Right. So Dhirendra, net, would you say that if at all you're looking at gold as an investment opportunity, it should be from a short-term time frame, and this should not be a long-term allocation?
Yeah, at best, you can take a punt on gold when things look grim, and if you look at 10-year return of 5-year, the 5-year return of gold is 1.25%. And with taxability it is virtually nothing, so it just remains a store of value. 10-year return looks very impressive, but that was actually the low. We saw the big surge, about 8% return. 10-year return from gold is 8%. But during this period we also saw that inflation wasn't also low, so real return from gold on a long-term basis may not be there. I would say that yes, one can take a short-term view, but I don't think most individual investors should be taking a short-term view. You should be guided by your own plan, and I think for short-term you have fixed income where you get predictable return, because even in short run gold can surprise you.
Okay. Right, but how? So here's the thing about investing in gold via the ETF route. I think a lot of people still believe that having gold in physical form is perhaps better. Could you kind of in a way draw that comparison and give our viewers a sense in that how that may not be the most prudent exposure?
Yeah, there are different forms in which you can own gold today. The raw form is having the gold coin available from a bank and somewhat underwritten purity, but easy to buy, hard to sell. Then the next is buying the gold ETF. It's a financial form. You can buy it, but the return that you get is less the expenses, which is about 1 to 1.25%. Then the next easy form is gold fund, which in turn invests, you invest your money in the gold fund, and that in turn invests in buys the gold ETF. And it replicates the performance of gold, less expenses, less the expenses of the fund, fund as well. So you get lower return. So that expense can well be up to 1.5 to 2%. So you get 2% lower return on the gold fund as compared to 1% on the gold ETF, which you have to buy like a stock, and this you buy like a mutual fund. A new thing has come about, which I think is very interesting, which is the sovereign gold bonds. You get the gold performance, the return available from gold. It has the highest safety because it is issued by Government of India, and it underwrites the price of gold the appreciation of gold factored into those bonds. You get some interest over and above that, 4% more. And holding it over a longer period, more than 3 years, it is also subject to indexation benefit. So that I think is the finest form, if at all if you are a gold believer, and if you are a long-term gold believer, that is the best way to hold it, because you will not only get the returns available from gold, even more than that, and all other forms have expenses which lower the return.
Okay, so if one were to ask you a very simple question, what is the lure of a gold ETF versus a traditional mutual fund, Dhirendra, what would you say?
I would say that if you are a long-term investor, choose your multi-cap fund and be at it. Stay on course, stay calm and carry on. Any period of 5-7 years and more regular investing, you win.
We leave it at that. Thanks very much for taking the time out. This is an important discussion, given that most analysts on the street are very bullish on gold prices. And I think for viewers, the option to make money on gold, and a prudent one at that, is taking exposure through gold ETFs. So thanks very much for putting perspective on that investment vehicle.